The accounting cycle is the systematic process businesses use to record, organize, and prepare financial information. It's like the roadmap for ensuring all the financial transactions are accurately and reflected in the company's report. Let's start by looking to the overall process and its key steps. The accounting cycle consists of 8 main steps. First, transactions and analyzing to see their impact on business. Next, they are recorded in the journal in chronological order, followed by transfer journals entry to respective account in the journal ledger. Then automatically it will be shown in the trial balance, where we prepare the list of the account and their balances to ensure debits equal credit. After the trial balance is prepared to ensure debits and credit match, then come to the adjustment. This is the year-end adjustment that should be done to update for accrued or deferred items. Once that's done, we prepare an adjusted trial balance, generating the financial statement, and finally close the book to reset the next year. So I repeat the second part, which starts from making adjustment. At the end of the year, the company they update their account balances for accrued or deferred items. We break down in the next lesson. Then preparing the adjusted trial balance by checking all the different transactions with the trial balance, verifying debit and credit after adjustment, and making sure that our transaction is correct. Then create financial statement, which is based on the data from the trial balance. In the trial balance, it can be balance sheet account, or it can be income statement account, or some of them they will be linked directly to the cash flow statement. Now at the end of the year, when we want to close the books, so we make the account that we move for the next year only the balance sheet account. So we will transfer only the balance sheet account, and the income statement account will be sold and be zero, and the balance will be shown in the red. Let's dive deeper into first step, analyzing transaction. Every financial transactions affects company position in some way. When analyzing, you start by determining the impact on assets, liabilities, or equity. For example, when a business sells 1,000 of goods on credit, it increases account receivable, an asset, and or revenue, part of equity. This step ensure each transaction aligns with the accounting equation asset equal liability plus equity. Keeping this balance is crucial for accurate financial reporting. We have an example for analyzing transaction. This is the example that we have just given. Business sells 1,000 of goods on credit. So as you see, the impact on account receivable and revenue equity. Here you see that our asset is increased by 1,000, which is balance sheet. Then we have sales revenue increase by 1,000, which is part of the income statement. Here, don't look to the negative side because revenue, sales revenue usually is in the credit and it's shown negative. The next step is recording transaction in journal. Transactions are recorded chronologically using double entry bookkeeping. That means every transactions affects on at least 2 accounts, one with debit and other credit. We have the same example as we have seen before. The business sell 1,000 of goods on credit. Our account receivable is increasing. We see in the debit 1,000 in debit, and we have sales revenue with the same value in credit. We have an example. Company purchased 5,000 and office supplies on credit. So the journal debit office suppliers for 500. and we credit the account payable for 500. This is the account that we give it, and you can choose any account depending to the country and the company. The account name is Office Suppliers. Here we have description. This is the first transaction. Then we have a debit for 500. Here it's expenses. Then we have liability, account payable. It's in credit. Here, this is chart of account with summary of all the accounts. We have account for assets, account for liabilities, and we have accounts for equity. We have account for revenue. Revenue is always credit side, and expenses are debit side. When the journal entries are recorded, they are posted to the ledger for data tracker. Posting is about transferring journal entries to a specific account in the journal ledger. Think of the ledger as table for tracking each account, activities, and balance over time. We have an example for the traction for account payable. We have seen before the first transaction, which is company purchase 500 of office suppliers on credit. This is the account, journal ledger account for account payable. So when we book the first transaction here, we recorded account payable for 500. It's shown in the credit side, and it's reported automatically to the credit side and to the account payable journal ledger. And our balance is minus 500. That means we have to pay this supplier. Then next, in the end of March, the company paid for the vendor. The second transaction is booked, which is the payment for vendor. So we book it in the debit side, the account payable, and we make the bank account in credit. The journal ledger show all the details for account payable. And the same thing for all the other ledger like bank account or inventory or any other account. Next, we have in this part and unadjusted trail balance is a list of all the accounts and their balances. So in the previous example, in the journal ledger, we see all the details for each account. However, in the trail balance, we see only the balance. And this is the same for account payable. You can see the balance for the first transaction, and you see the balance for office suppliers and utility for 500 as debit side in positive. So you make sure that we make checking to make sure that total debit equal to the total credit as preliminary error check. The purpose of the trail balance is to identify any potential recording or posting mistakes, because in accounting sometimes we make mistake. Now we have financial statement preparation, which is the trail balance helps to prepare the financial statement, because to prepare the financial statement we get the data from the trail balance. Then step number 5, making adjustment entry. This updates account balances for items that haven't been recorded yet or were deferred. There are 4 main types. We have accrued revenues, revenue earned but not yet received or recorded. Accrued expenses, which is expenses incurred but not yet paid to suppliers. Deferred expenses, which is payment received in advance for the future services. It can be payment received related to service that we will provide for this period and for the next year as well. And also can be deferred expenses, which is payment made in advance for future expenses, like paying for a rent for a period of 12 months. So here an example for adjusting entry. We have depreciation, booking for annual depreciation. The company debit expenses account for 1,000, and we credit the accumulated depreciation for the same amount. So here our account is 6,800 depreciation, which recorded in the debit side. So this is cost account, and it will be booked in the income statement. Then we have accumulated depreciation, which is balance sheet account, which is asset account. Here it's included. We will reduce the value for our assets, so it will reduce the value for the property, plant, and equipment. After we have recorded all these transactions, let's update the trial balance to reflect these adjustments. Step number 6, preparing the adjusted trial balance. The adjusted trial balance includes all adjustments made to account balances. These steps ensure debit still equal credit, reflects the most accurate picture of the company finances. In the final cook point, before preparing the financial statement, ensure everything is complete and accurate. Preparing financial statements include the income statement, show profitability over period, detail revenue, expenses, and net income. Balance sheet summarize assets, liabilities, and equity. Cash flow statement report cash inflows and outflows for various activities. Then we have also statement for change in equity, which reflect changes in equity over the period. Each statement offers unique insights, helping stakeholders understand the business. Finally, we close the book to reset the next cycle. Here we have an example for the income statement, with showing all the different transactions. Here the data is empty because we have reported only 1,000 for depreciation, and you see the different information about net sales and operation expenses. We have operation profit, EBIT, and net income. Next, this is an example for balance sheet, which is total asset equal to total liabilities. Then we have cash flow statement overview for the period, which is empty because we haven't yet booked any transaction for the period. The next and final step, which is closing the books. So closing revenue account, transfer revenue, balance to returning earning. At the end of the year, the company have to close the current year to open a new year. We will bring the next year in the reopen balance, only the balance sheet account. So income statement account is not needed. So we have to adjust them and post a booking. So we will transfer revenue balances to returning earnings. We have said before that returning earnings are the profit not yet distributed to the shareholders. So here we transfer revenue balance to the returning earning. Then we do the same thing for expenses, where we have to transfer expense balances to returning earning as well. Then transfer the net income loss to returning earnings. And net income or loss is the difference between revenue and expenses. So our profit for the period will be shown in the returning earnings, even it's income or loss. The purpose for closing entries is to reset temporary account, which is account related to the income statement, to the new period, update returning earnings. So our returning earning will show automatically the performance for the company and begin the new cycle, which is the new year, and show only the balance sheet account. We have an example for closing entry. Company has 1,000 in revenue for the period. We will debit revenue for 1,000 and we credit income summary with the same amount, 1,000. So here the transaction, this is the end of the year, the 31st December 2025. Sales revenue, it will be in the debit side because we will cancel the revenue, and we credit returning earnings with the same amount, and which will be shown in the balance sheet account.